Okay, so someone hands you a hotel. Not a room you rent out on a booking app, the real thing. A marble lobby, a bellhop opening the door, valet pulling cars around under a covered entrance, guests checking in at every hour of the day, room service trays clattering down hallways at midnight. Every single night, hundreds of rooms fill up, and every single one of them pays you just for existing. It feels like the cleanest business model in the world. Build the rooms, sell the nights, forever. It is not that simple. Owning a hotel is one of the most capital-intensive, operationally relentless businesses in all of real estate, because unlike an apartment building where a tenant signs a lease for a year, a hotel has to sell out its entire inventory again, from scratch, every single night, 365 days a year, with no season off and no tenant loyalty to fall back on. There are hotel owners who have built real estate fortunes across entire portfolios of properties. And there are hotel owners who bought at exactly the wrong point in a cycle, financed it with the wrong kind of debt, and lost the entire property within a few bad years. Here's the thing about this business. The hotel brand on the sign almost never belongs to the person who actually owns the building. Let's be clear about what you're actually buying, because hotel hides one of the most important and least understood distinctions in all of commercial real estate. In the vast majority of branded hotels in America, the company whose name is on the sign, Marriott, Hilton, Hyatt, does not own the building at all. They franchise the brand and, in many cases, manage day-to-day operations, while the actual real estate is owned by a completely separate investor, sometimes an individual, sometimes a private equity fund, sometimes a publicly traded hotel real estate investment trust. This script is written from the perspective of that owner, the person who actually put up the capital for the building and carries the real estate risk, not the brand company collecting fees from the sidelines. Within that ownership category, there's a further split between full-service hotels, the kind with restaurants, banquet space, and room service, and select service or limited service hotels, the more efficient, low-amenity properties that have become the dominant growth category in the industry because they cost less to build and less to staff per available room. Let's talk about what it actually costs to build or buy one. The hotel industry measures construction cost using a metric called cost per key, meaning the total project cost divided by the number of rooms, and that number varies enormously by category. A limited service hotel might run somewhere in the range of $150,000 to $250,000 per key to construct, while a full-service hotel with meeting space and food and beverage outlets can run $300,000 to $500,000 per key or more, and true luxury properties can push well past $1 million per key once you account for the level of finish and amenity expected at that tier. A modest, 200-room select-service hotel, then, can easily represent $30 to $50 million in total project cost, and that's before you've generated a single dollar of room revenue. On top of construction, if you want a recognized brand on the building, you're paying franchise application and initial fees to the brand company just for the right to fly their flag, a cost that exists entirely separate from the physical construction itself. Before you open the doors, you also need infrastructure that most guests never think about at all. Furniture, fixtures, and equipment, known throughout the industry simply as FF&E, meaning every bed, every television, every piece of lobby furniture, every kitchen appliance in the restaurant, represents a massive standalone capital cost that has to be replaced on a recurring cycle, typically every 7 to 10 years, because brand standards require it regardless of whether the existing furniture still looks fine to you. Technology infrastructure, the property management system that runs reservations and checkout, the point-of-sale systems in the restaurant, the guest Wi-Fi network expected to handle hundreds of simultaneous devices, is a significant and continuously updating cost category on its own. And if you're affiliating with a major brand, you'll eventually face what the industry calls a property improvement plan, or PIP, a mandatory renovation checklist the brand issues periodically, sometimes running into the millions of dollars for a mid-sized property that an owner has no real choice but to fund if they want to keep flying that brand's flag, because losing brand affiliation can meaningfully damage a property's booking volume overnight. Now let's talk about what it costs to run the thing every single day, because a hotel's operating costs are relentless in a way that few other real estate categories match. Labor is the largest expense category by a wide margin, because a full-service hotel needs housekeeping staff cleaning rooms daily, front desk coverage 24 hours a day, engineering and maintenance staff, food and beverage staff if there's a restaurant, and management overhead, all of it running continuously regardless of how full the hotel actually is on any given night. Brand fees are the second major category for any franchised property, typically structured as a royalty fee calculated as a percentage of room revenue, plus a separate marketing and reservation system fee that funds the brand's national advertising and central booking platform, meaning a meaningful slice of every single room sold gets paid straight to the brand company before the owner sees a dollar of it. The FF&E reserve is the third major category, an ongoing required set-aside, often around 4 to 5% of total revenue, specifically earmarked for the periodic furniture and renovation cycle we just covered, money the owner is contractual required to save regardless of how the property is performing that particular year. Utilities, property insurance, and property tax round out the major fixed costs, and property insurance in particular has become an increasingly volatile cost category in recent years, with premiums in certain coastal and disaster-prone markets rising sharply enough to materially affect a property's overall profitability on their own. Here's where the revenue model gets genuinely interesting, because the entire industry measures performance using a single combined metric called RevPAR, revenue per available room, calculated by multiplying the average daily rate a room sells for by the hotel's occupancy percentage. This single number matters more than almost anything else in the business, because it captures the fundamental tension at the heart of hotel revenue management. You can chase a higher room rate and risk lower occupancy, or chase higher occupancy with discounted rates and risk leaving money on the table on the nights you could have charged more. And modern hotels employ dedicated revenue management systems specifically to optimize that trade-off night by night, sometimes hour by hour. Room revenue is the core of the business, but ancillary revenue, food and beverage, parking, meeting and banquet space, resort fees, increasingly makes up a meaningful share of total revenue at full-service properties, and at some luxury and resort properties, ancillary spending per guest can rival or exceed the room rate itself. Group and meetings business, corporate contracts, wedding bookings, and convention room blocks, provides a more predictable, often high-margin revenue stream that smooths out some of the night-to-night volatility of pure transient leisure demand. And here's the trap sitting inside all of it: online travel agencies, the booking platforms most travelers actually use to find and reserve rooms, charge commissions that typically run somewhere between 15 and 25% of the booking value, meaning a meaningful share of revenue on any room booked through a third-party platform never actually reaches the hotel's bottom line at all, which is exactly why hotels spend so much marketing effort trying to drive guests toward booking directly instead. Let's build the two honest scenarios. In a good year, RevPAR growth is strong across both rate and occupancy, group and corporate bookings recover fully, direct booking share increases relative to costly third-party channels, and the FF&E reserve stays comfortably ahead of any near-term renovation obligations. A well-run 200-room select-service hotel in a strong market might generate operating margins in a genuinely healthy range once labor, brand fees, and fixed costs are covered, producing real, distributable cash flow to the ownership group on top of debt service.
In a bad year, recession, or a demand shock suppresses both business and leisure travel simultaneously, RevPAR can fall sharply within a matter of weeks, and because labor, brand fees, debt service, and the FF&E reserve obligation don't meaningfully shrink just because fewer guests are checking in, a genuinely severe downturn can turn a previously healthy property into a serious cash flow emergency almost overnight, a dynamic the entire industry experienced simultaneously and dramatically in the spring of 2020. The clearest real-world illustration of this entire dynamic and of the ownership versus brand distinction covered at the start of this video is what happened to the hotel industry during the early months of the COVID-19 pandemic. National hotel occupancy in the United States, according to industry data from firms that track the sector, collapsed to somewhere around 20 to 25% in April of 2020, down from a typical pre-pandemic occupancy level in the 60 to 70% range, and RevPAR across the industry fell by roughly 80% year-over-year during that same stretch, numbers essentially without precedent in the modern history of American hospitality. Individual hotel owners, the people actually carrying the real estate and the debt on these properties, bore almost the entire brunt of that collapse, with a wave of loan defaults and forbearance requests across properties financed with commercial mortgage-backed securities debt that had never budgeted for anything close to a demand shock of that magnitude. The major branded hotel companies themselves, Marriott and Hilton among them, weathered the storm dramatically better in relative terms, because their business model had already evolved by that point into something closer to a fee-collecting franchise and management business than a real estate ownership business, meaning their revenue took a serious hit from lower royalty and management fees, but they weren't the ones facing foreclosure on properties they didn't actually own. The buildings themselves never stopped being valuable long-term real estate assets. The people caught holding property-level debt with no revenue coming into service it are the ones who actually absorbed the crisis. Now here's the twist that this entire video has actually been circling from the very beginning, because it's arguably the original version of a pattern that's shown up repeatedly across this series. Starting in earnest in the 1990s and 2000s, the major hotel brand companies deliberately restructured themselves away from owning real estate at all, selling off the hotels they used to own directly and converting their business model into what the industry calls asset-light, collecting franchise royalties and management fees from properties owned by someone else entirely, while taking on none of the property-level real estate risk, the debt, the insurance exposure, or the renovation obligations that come with actually holding the asset. This is the exact same real estate versus operations split we've now seen show up in casinos, in data centers, and in ski resorts throughout this series, except in the hotel industry. This restructuring happened earlier and more completely than in almost any other sector, which is precisely why Marriott and Hilton's stock prices recovered so much faster than the balance sheets of the individual owners financing their actual buildings during the pandemic. For an investor evaluating where to sit in this industry, the brand company offers a capital-light, fee-based business with genuinely high margins and low real estate exposure. The property owner offers real, tangible real estate ownership with meaningfully higher risk, and meaningfully higher potential reward if the property is well located, well financed, and well timed relative to the broader travel demand cycle. What separates the hotel owners who build lasting wealth from the ones who lose the property entirely is almost never the quality of the brand on the sign, since both groups can and do operate under the exact same flags. What actually determines the outcome is whether the property was financed with debt structured to survive a genuine demand shock rather than an optimistic projection of RevPAR growing forever, whether the FF&E reserve was actually funded rather than treated as an optional expense to skip in a tight year, and whether the owner understood, from day one, that they were carrying real estate risk that the name above the front door was never actually sharing with them. The lobby will always look the same: marble floors, a bellhop, a guest checking in at midnight. Whether the person who owns the building underneath that lobby survives long enough to profit from it is an entirely different question.